Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome back to Metcalf Money Moment podcast. My name is Jeb Graham, here with Ethan Hutchison and Eric Wymore, who are partners and co-hosts on the show. And we have a guest today named Alan Smith. Alan Smith's an insurance agent or independent insurance agent with Blue Valley Insurance and has been my insurance agent for, Alan, probably 15 years or so now, quite some time. So how's everybody doing today?
Doing great, thank you.
Doing good. Doing well.
Yeah. We're done. So we're actually recording this on April 16th, which is the day after tax day. So our world's kind of calmed down a little bit. And, one of the things, and Alan, one of the reasons we wanted to have you on here is we have obviously a lot of clients that come to us and ask us about property casualty insurance at times. When I say property casualty, I mean personal lines like their homeowner's insurance, their car insurance, if they're insuring a boat, and things like that. And I think the common theme, and we all know it, everybody that pays any sort of insurance premiums, is that the cost has gone up significantly over the last few years. And not only has the cost gone up, there's certain companies that you used to get insurance from that you can't get insurance from in certain areas and stuff like that. And I thought this would be just a great opportunity, and Ethan and Eric and I were thinking it was a great opportunity to have you on and maybe just talk about some of the reasons that insurance has gone up and kind of just what's going on with personal lines insurance and the industry as a whole.
Yeah, and thanks for having me, Jeb. We're in officially a kind of an insurance slump, right? The insurance markets have definitely hardened up. I guess what I would say is that, like you, I'm sure before tax day, you guys get a lot of calls and questions on everything from whatever. But right now, we're seeing more calls and questions and concern over their rate than we've ever seen in the past. And what I would say, to kind of provide a little bit of a backstory of what's happened in the last decade. I've been doing this for 18 years now, and I've never seen rate increases like I've seen in the last 2 years. Some of the things that, and we can point to a few things. Inflation is probably the number one thing. As costs of building materials, as labor rates have increased dramatically, it's increased claim expenses dramatically. The second thing that we're seeing is just claim frequency is up. Roofing claims are way up. I mean, I remember, I've been doing this for a long time, and I remember the last hailstorm that we had that was a major one was in 2011. And I woke up the next day and there was like 100 phone calls that I had to reach out to because they had roofs. Those were easy ones to adjust, though, because they were softballs. They broke windows. We had a similar event in Shawnee, I think, late last year, where, again, big stuff. What we're noticing specifically, like if I were to talk about each one, like home being the first one, property rates have, in the last 2 years, have nearly gone up 200%. When I started writing policies back in 2008, right before the financial crisis or whatever, average home rates were around $700 a year. And that was on a $250,000 house. That same $250,000 house now costs around $600,000 to build, right? So just thinking about those numbers there, I think people are starting to realize, like, wait a second, everything does cost a lot more, number one. But number two, in the last 2 or 3 years, because when roofs start to age out, we've got a lot of roofing companies. I almost want to say that insurance companies have started to subsidize roof replacement. And it's getting out of control to a point where insurance companies, frankly, are just losing money, and they're passing those losses on to every consumer for those of us that haven't filed losses. And so what's been painful is that, so those customers that maybe haven't had the roof replaced and they've got a 15-year-old roof. Jeb, you talked about it earlier about carriers getting out of the marketplace. I mean, there's a misconception in the Midwest that we're a profitable territory. In fact, we haven't been over the last 3 to 4 years, simply because the amount of money they're paying out in claims are more than the revenue they're getting in premiums. So they've had to make.
Is that from hailstorms? So is that mostly from hailstorms?
It's hail, but I mean, we always get hail. I think what's been unique is that every time we get a small hailstorm, I get 100 calls. I think there's a lot that we've created. We've created a lot of jobs for roofing. I think, and I can get to in a moment, I'll tell you kind of the differences that'll be coming out, which are not so great for the consumer, but from a pricing standpoint will stabilize. But it's the same thing kind of anecdotally on the auto premiums have gone up dramatically. I mean, we used to talk to customers like if you don't have any speeding tickets or accidents, your rates would trend downward, right? Because your car value would theoretically go down and all that good stuff. Well, cost to fix things is dramatically more expensive. I mean, you know, COVID was a big year for us where we saw a big disruption in the industry simply because supply chains supply chains for parts, and if, again, with the economic world we're living in now, with tariffs potentially changing things, I mean, that could make things worse potentially. And again, I'm not here to debate that, but what insurance companies are doing is they're building in rate for factoring in those possibilities, right? So, when you get parts that are coming from examples, in 2021, a common claim that we saw on electric vehicles like Teslas, for instance, to fix, if you had a bump on a bumper, like you hit somebody's bumper that costs around $5,000 to replace. Now keep that in mind. 10 years ago, that same bumper without all the cameras cost a couple $100, right? These cars were getting laid up for 6 months to a year, and let's say you wrecked into one of those cars, we may have to buy that car. We would total that Tesla because it was laid up for a year. We owed a rental car for that person for 6 months to a year, and that cost of the rental car was more than the value of the car. So we were totaling those cars. So, and that's another thing too, just looking at what types of cars. Maybe call your agent before you buy the car. Say, hey, what's this going to cost me? Because yeah, there's definitely some savings and benefits to buying EVs. Don't get me wrong, but from insurance, I can tell you, they're sometimes 2 or 3 or 4 times more expensive to insure than a standard, just a gas vehicle right now. So I mean, again, this is just it's alarming. What I would say right now is that things are changing, and I see on the property side what I think they're going to do, and we're already seeing the changes kind of going forward, is that, they're going to change the way they cover roofs. So for those people that have gotten new roofs in the last few years because of hail events, congratulations, because those days are starting to come down to a point where, the old deductible of $1,000 or $500 on your property, that's gone.
I do remember back that hailstorm that you're talking about. Maybe this was 5 or 6 years ago, because we got a new roof at our old house because of it. And I remember almost everybody in our neighborhood got a new roof, and I felt like it wasn't like the roofs were completely totaled out, but it was almost like the insurance companies, or you tell me, were they kind of just loosey-goosey back in the day, and
They
now
were.
we need to tighten this thing up?
They were. I think the thing that's the challenge, and this is my opinion, is that if you have a 10, 15-year-old roof, you live in Kansas, you're probably going to have some hail hits over a 15-year period. And so when the industry gets hot, like it's been in the last decade, roofers are knocking on doors, and all they have to do to get the roof approved is like, say, 10 or more hits on a slope. Your roof could be probably fine. It's just kind of, you got some normal wear and tear, you've got no leaks. But if your neighbors are getting roofs, what are you going to do? You're going to call the insurance company and get a roof claim. Again, and that's where it's been hard, is that asphalt shingles is the cost of those roofs. And again, there's a lot of fraud and waste going on too. And that's why we always tell our insureds, when they're calling us to report damage, make sure you get a local roofer, not be leery of the people that are knocking on your doors, right? They drag down the claim experience, because here, like when people call, we've had roofers that are actually calling on behalf of the insureds. If you start getting that's don't use that guy, or that person rather. The amount they're charging for roofs, for the same roof that I know that are getting roofs for new construction or whatever, is nearly 3 times as much, and insurance companies are paying it. And it's just kind of a dredge for everything, right? At the end of the day, the insurance companies are going to look at the bottom line and like, hey guys, we just paid out $50,000 for that roof, and we've been collecting $2,000 a year in premium. It all adds up.
Numbers don't add up, right?
Yeah. And that's what they're doing, is that I think in the future. So I guess what I would say, what I've seen and what's been going on in the marketplace from an insurance standpoint, is that, so we are in a hard market. Because insurance companies have been losing so much money, half of my companies are frankly not writing new business right now. They've just stopped altogether. We've actually lost 3 markets in the last 3 years. And again, my prior 17 or 16 years before that, we'd never seen a carrier exit the market. This because you were with one of our carriers with Nationwide Private Client. They just non-renewed every customer in town, and they said, we're pulling out. So we're not immune to what's happening in the coast, because the Midwest is getting hit. Maybe not as dramatic like fire, but that's the things too, is like there's some misnomers, like the fires that were going on over there in California. A lot of the insurance companies they got rid of they stopped offering fire coverage a long time ago. So there's a lot of uninsured people out there. So I guess where I see what's going forward I see in the Midwest is that they will start going to a payment schedule if they already haven't already. So what that looks like for you is that if you've got a 15-year-old roof, they may depreciate the roof by 30 or 40%. Okay, so on a $20,000 roof, you might get 50 to 60% of that value before they apply the deductible. And so all of a sudden, instead of being out $2,000 to $3,000 on a roof claim, you could be out $10,000 to $12,000 on a $20,000 roof claim. And so it's just going to mitigate their exposure, maybe help reduce the frequency of claims when people know they have to come out of pocket so much. But I mean, I don't want people to think that you shouldn't file a claim, but I guess what I'm getting at is that now more than ever, don't waste your time filing a claim unless you know absolutely you have damage, because insurance companies have kind of put a kibosh on, like you said earlier, like the 6 or 7 years ago where they just cut checks. Those days are starting to become to an end.
I got a good example on that. We have a 2-year-old roof, and last summer we had probably a good half dozen roofing companies knocking on our door saying, "Hey, you got neighbors that are filing claims for hail." And I went out and looked at my roof. I go, "It's 2 years old. I haven't even seen hail down here. What's going on?" And he goes, "Well, the insurance company will pay for a new roof for just your deductible." And I'm like, "I'm not going to pay a $2,000 deductible for a 2-year-old roof or whatever." And he goes, "Well, let me get on there and I'll find some damage." And I opted out of it, but we got probably 6 or 7 people knocking on our door because we had one neighbor got a new roof, and they've been there for 3 years. And we're like, this just doesn't add up.
And that's the thing is, like, you can get, and this is what's been crazy for me, is that I often tell my customers is I don't think it's a bad idea to get a good roofer for, like, to actually review, because if you got damage, you should file a claim, right? I think at the end of the day, but we are seeing a lot of claims that are frankly unnecessary. Like soft metal damage is a good example. Your downspouts, guys, if you don't see any dents on your downspouts, it's a good chance you don't need a new roof. Okay. Because those are always going to be damaged before your shingles are. The other thing is too, is that even if you have a couple, maybe have a local roofer. And again, I'm not going to refer any per se here, but it's good to know people that have been around a long time that don't, I guess, their money's not derived off of just roof insurance claims. In fact, if it were up to them, they would do no insurance claims, because if anybody's been through an insurance claim, it's not always the most pleasant experience, right? There's delays. You're dealing with some adjusters are better than others. There could be nickel and diming depending on the company and who the adjuster is. And it's just a fight. And the infighting really begins when you're using, like, these storm chasers I was telling you about. The problem I've been noticing is that they come in, you should see the bids we're seeing for some of these roofs. And so the adjusters have to just go, "Are you kidding me?" And then it just slows. It slows the wheel, and it slows everybody else down, because all of a sudden you get 15 of those in one day, and every one of them you're fighting about the amount it actually costs. And at the end of the day, the insurance companies oftentimes just give in. And it's at a point now where I guess the long term is that we need to be careful on those, and I'll get to strategies too, as far as how to kind of maybe get your premiums lower. You want me to segue into that a little bit, that Jeb, and just kind of.
Do you want to ask the question, Eric, or maybe ask your question? And then...
Absolutely. Yeah. So, Alan, I mean, you've been talking about how the different costs come around and how they've gotten there. One of the things we always talk about in our world is things that we can control. How would a consumer go about controlling their insurance costs, or what are some of the things that they need to do or can do to help, lower that premium amount?
Well, let me start with two things too. Is like, why are rates higher and lower for certain people than other people, right? We know on property, like your roof age is going to have a bearing on that. Okay, so the older your roof goes, believe it or not, the rate's going to be. And so again, for those people that put your new roofs on, make sure you tell your insurance company, because that does improve the rate with most companies. But the biggest factor right now that I've noticed that is hurting or helping rates is credit. Carriers are really, I guess actuarially, they're finding that people that have better credit file less claims, and it would make sense from just a common sense approach, right? If you've got good credit, you could be potentially taking care of your property better. But that's the thing is that, so underwriting has never been so strict. And so credit score, keep your credit good, pay your bills on time, those kind of things. I know that seems like common sense again, but that's going to have a bearing on your rate. Because the old adage is like, well, my neighbor pays X, so why am I paying Y? Well, his credit might be perfect and he's never filed a claim, But I've seen, it's such a difference, like on the same home, let's put things just for a $500,000 house on a new construction. Someone with a 750 or higher credit score is probably looking at around, on a new construction thing, around $1,500 a year. That same person with like a 640 credit score, which used to be okay, or somebody that's maybe a first-time home buyer that doesn't have a lot of credit or never had built up credit, that same rate that was 1,500 could be 3,500 to 4,000 a year.
Gotcha.
That's just credit.
Yep.
The risk is not
So
changed.
keeping that credit score, that's really interesting of how, keeping your credit score up is really important in a lot of regards. But a lot of people I don't think realize that how much it
Several
impacts
of our
insurance.
carriers didn't even rate for credit. One of my last ones was Lidditz Mutual, a good company that we've had access to for years, and they finally switched it, and they've made it to a point because they feel a little bit oversaturated in the Midwest. You have to have an 800 credit score to even quote them.
Yeah.
So,
well, hey, real quick back there. So you're talking about Lidditz Mutual, and I know since I've been with you, maybe it's been like we were talking about 15 years or so. I've probably had 3 or 4 different carriers that we've used, maybe 2 or 3.
Mm-hmm.
Okay. So I think that's important. We're independent financial advisors, right? So what that means is we don't work for a company, we work for our clients. And I know with you as an independent insurance agent, you don't work for a company, you work for your clients. So you're basically going out to different companies, you're pricing out insurance, and you're trying to find the best deal. And maybe just talk a little bit about the difference between a captive agent, you as an independent agent, and maybe some of the costs that are saved in that regard as well.
Yeah, great question, and thank you for bringing that up. I think your captive markets are going to be the ones you probably hear about on TV. They do advertising the most. Okay, captive markets are going to be your exclusive agents, State Farm, Allstate, Farm Bureau, Farmers. Those are going to be captive markets, and as a captive agent, you work for the company as a W-2, right? And you sell their products, and their products can be good. The one thing, as an independent broker, we don't have access to exclusive markets. So oftentimes I'll get calls like, hey, can you shop me State Farm? I'm like, I'm sorry, I can't. You'll need to call the local State Farm agency. We have national markets. As a broker, though, we shop the carriers that we're appointed with. We have national carriers, like you've heard of, Travelers, Nationwide, Progressive, Liberty Mutual. Those carriers also sell direct. They have a direct channel, right, where you can just go online and pick your coverages. And we also have mutual companies that you may not have heard of, like Cincinnati. Chubb is a good example of a independent agent exclusive, right? But we've got a lot of mutual markets that you might not have heard of. And I guess the benefit of captive, and if you're an agent per se, is that it's a nice safe home. And if like they train you, they bring you in, and a lot of the referrals come in through their advertising, right? And so when you work at a captive agency, you just have a few products. But and like a State Farm's a good example because they're still one of the biggest, right? Sometimes just like my big companies, they dip and dip out, right? They'll come in with low rates, and then next year they have poor loss ratios, and so they raise their rates. Okay. We've seen it over the last 17 years, and I've had you, and I'm specifically, Jeb, I think I've had you with 3 different companies, right? Just there's times where the rates go up with a company, and then we just want to remarket and just make sure that, hey, are the rates better anywhere else? And so that's the benefit of a broker, is that I guess from my, selfishly, is that we have the ability to shop. Now, not always are we going to be better than an exclusive market. I guess the benefit, but again, by having 13 markets like we do, I mean, the odds are 99% of the time one of our markets is going to be pretty close or lower than one of the captives. And that's where it's changed a little bit recently, simply because we are limited even on the independent channel of writing new business because of the hard market we're in. Mm-hmm. But the nice thing is that we have the ability to shop and move people around, right? That's the benefit of a broker.
Nice.
Yeah. So anything with teenage drivers, right? Teenage drivers coming around.
We talked about this before, yeah.
How do you get that rate?
Well, I mean, yeah, and I'm glad you're back into yeah. What is a challenge right now, and I almost feel bad for and I've got kids that are about to start driving. I know, Eric, you do too. Jeb, you've got a youthful operator right now. I think the sad part right now is that they are charging a lot more for kids than they ever have before. All right. For all those people that are about to have kids drive, I would say, estimate $200 a month before you even add a car. That's the additional expense you're going to look at for just adding a kid. And it's so important, I guess, with kids. The biggest thing I'll tell you with youthful operators, number one, grades do help. That's the most important discount. So 3.0 or above, that's a huge one. The driver's education courses that you can take, there's a slight discount there. But the biggest thing I can tell families is to really review your policies at that point going forward when you're adding a kid. I know what we do for our customers is that before adding a young driver, we shop it. because there's such a variance between companies whenever we're adding a young driver. Not all of my markets are good with kids and they don't want them, and so I might have you with them because you got a good bundled rate with them now, but once you add that kid, it could be $400 more a month. We got to move you. All right. But the biggest thing I can tell you is that, with adding kids is that, again, maybe increase your deductibles at that point. When you've got a fleet of vehicles and all of a sudden you're spending $8,000 to $10,000 a year for auto insurance, which is insane, right? But that's what average families with 3 cars are paying with youthful operators right now. It's look at your deductibles, and that's the same thing on your home. And we're going to talk about things to review with your agent, but look at your deductibles. Maybe consider self-insuring some of those smaller things that you used to maybe not because you didn't care, right? Carriers are, because you're already going to pay a higher premium, and so what carriers are doing is that so when anybody gets in an accident, right, it's usually about a 20% surcharge for 3 years. All right, so the more premium you're going to be paying, you're going to pay a higher increase just because of the fact you're already paying a higher rate. And so it's really important to talk to your kids, about this stuff, about safe driving. But distracted driving is the real cause of why insurance rates are going up so much with auto, and especially with youthful operators. I don't know about you guys. Every time I stop at a stoplight, if I look to the right or left, there's somebody on their phone. And kids grow up with devices a lot earlier than we did. They're always on them. And I think the problem is that's why you can have the safest cars that tell you when to stop and stuff like that. But what we're seeing, so it's like a trifold effect. Cars cost a ton more to fix. Kids are getting in more accidents. So are adults, by the way, because of distracted driving, right? And the severity of accidents have actually increased. When you got people going 70 miles an hour not paying attention, they're hurting people, right?
Mm-hmm.
So we're also seeing that. So it's just kind of like a weird, as cars get smarter, it'll be, again, I joke because there's cars that drive themselves. That'll be kind of interesting. But
well, I was actually, oddly enough, I was hanging out on a neighbor's driveway last night, and another neighbor drove up that has just got one of the self-driving Teslas. Like, just out of curiosity, we don't need to spend a lot of time on it. Is that more expensive or cheaper from an insurance standpoint?
I think oftentimes insurance is lagging on this stuff. That's part of the reason why we see such huge increases after they started putting all these EVs in, right? All I can tell you is that all Teslas are going to cost a little bit more money than your standard just gas vehicle. I haven't seen any data on it, whether or not the self-driving is going to improve the rates or not, because they're pretty new. And from what I got, insurance are kind of these behemoths that whenever they try to change rates, it takes time because they got to notify the state of increases, and when they got to file rates on cars. Part of the reason why we're getting so many calls on auto renewals right now is because so many people have Teslas, and all of a sudden their rate, and they're like, I didn't do anything. My rate went up $1,000 because you got a Tesla, or you've got a Rivian. My neighbor right across the street, he's got a Lucid. Have you ever heard of those cars?
Yeah, those are pretty good.
He's got
cars.
A cool car. Yeah.
Yeah.
And again, I don't want to speak ill of Lucid or anything like that, but he had a chip in the windshield so the windshield needs to be replaced. He's got full glass coverage. All the companies use Safe Flight glass on average. And again, back in the day, a windshield less than 10 years ago was around $200 to replace. But now you've got forward collision avoidance. You've got all these sensors that are in your windshield that they're making thinner, right, to make them lighter. They crack all the time now. So we're seeing all these glass claims. But the point I'm trying to make with this car specifically, and this literally was 2 days ago, it took them, number one, Safe Flight wouldn't do it. They couldn't do it. Okay. No body shop in town could do it. The closest one that would mess with it was a body shop out of Nebraska, and the cost to replace the windshield was over $5,000.
Wow.
Oh, wow.
It's like, what?
Yeah.
Yeah.
You used to be able, you could get a used car for $5,000.
And that's what's crazy is that the industry from a premium standpoint has changed so dramatically, right? Just because of the cost of all these repairs.
Yeah. So Ethan, did you have one, or do we have one more question? So we'll do that.
Yeah.
And then we'll wrap up. How's that?
Yeah. Last one we got for you here, Alan, talking about, being proactive from the consumer's perspective. What can we do? You hear a lot about bundling, increasing deductibles, looking at discounts, reviewing your home appraisal every year, all that. Is there anything, do you guys take care of that, or is that on the consumer to kind of be proactive?
Yeah, I think that, so we've been a bit more reactive lately simply because everybody's rates went up over 20% for the most part. I know as a broker, not every broker is going to be the same. We're more triaging the bigger increases right now. But what I would say is that you should review and call your agent once a year. Even if it's a simple email, just check in, say, hey, is everything about the same? Because even me with a clientele, if it's under the amount, I don't automatically shop. And I think it's important to tell everybody you shouldn't move your insurance every year. And that means if you're with a captive or with any agency, because carriers are now rating two, like you got two customers, right? One customer that's been with the same carrier for 10 plus years, and you got the other customer that's been with 6 different companies in 6 years. Who do you think is going to get the better rate when they go to quote?
Right.
I guess what I'm saying is, unless you're winning, if you're not going to save like 5% or more, you probably shouldn't move your insurance anyways. But ways to really look at your coverages and talk to your agencies about, like, as far as deductible is going to be the number one lever we have to reduce your premium. All right.
Okay.
Rebuilds, the cost to insure your home, that's kind of taken out of the ballpark nowadays, because the carriers are pretty much saying, hey, this is what we're going to insure it for, whether you like it or not. All right. So my customers, the ones that I see the most need, and probably you guys see on your book, if they've been with the company for 5+ years, A, they probably should be remarketed. Okay. But B, they absolutely at minimum look at their deductibles, because I cannot tell you how many times I've seen customers call me to quote, and they've got a $700,000 house with $1,000 flat deductible. And they've got a ton of money. They got money that's savings. They never file claims. I ask them, do you ever file claims? He goes, no, I self-insure anything. I'm like, well, then make your deductible $5,000. The premium differential you get from just going from $1,000 to $5,000 could be 50%. All right. Because the way the carriers are going, remember I told this, like where they're going to is a 1% wind and hail, or 2% in some cases, right? So if you've got a $500,000 house they're insuring, 1% is going to be $5,000, 2% could be $10,000. Now again, the direct writers, that's what they're offering the consumers, 2%. All right. And people are selecting it and they don't even know what they're getting. So we try to advocate, like, look, that might be out of your ballpark. You realize you're self-insuring the roof at that point, right? So I would say deductibles, review your discounts, because there are discounts now that they're offering they hadn't before, like backup generators. Some of our companies are doing that. Another common one is this, like, you heard of the automatic water shutoff devices? Those are pretty common now. There's some pretty good credits that you can get there. So if you install one, make sure you tell your agent. Those are the things that basically, if there's a leak if there's a pipe, that leaks or whatever, it shuts off the water automatically. And then obviously your alarm discounts. And on the auto side, same thing. Look at your deductibles. Make sure they're rating for the proper use. If you work from home and maybe you don't put a lot of mileage on your car, they could have been just assuming you were a commuter, 10 miles commute, right? If you're putting less than 8,000 miles in your car, make sure you let your agent know. That could help your rate out.
Those are all great pieces of advice. And I think, like, look, the kind of what you're saying there is it seems like to me it's a really good time, like, because the biggest listeners of this podcast are going to be our clients. I think this is a really good time to just review policies, right? So if you've got whoever your insurance is with, I think I'm always an advocate of an independent, just in general, right? Because I think it creates a lot more options, and that it's at least getting shopped around. And I think so I think that's a good thing. And I think I know you've done a great job for me and for a lot of clients that we've sent you over the years. So we certainly appreciate that. And also want to wish you good luck in your golf game tonight. I hope you go out there and do well. So,
thanks for calling me out.
Alan and I are getting ready to play in a member guest tournament here in a couple months. So we're planning on winning it. Is that right?
Thanks for having me, guys. I really appreciate it.
Yeah, thanks for coming on. And this is Metcalf Money Moment podcast signing off.
Yeah.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.